Welcome back to Squawk Box. Join us right now for a wide-ranging market discussion. Greg Fleming is here. He's the president and CEO of Rockefeller Capital Management. He's also former president of Morgan Stanley Wealth Management. We are always trying to figure out where we are in the sort of cycle of things. We've been watching a lot of earnings come out. You had Google come out spending a lot of money. There was a period of time where people loved when companies spent money. Now they don't like them spending money. Where are we really?
You know, I would say, first of all, we're always in that time, and it is, you know, we want to live in interesting times. They certainly are with the technological change here. I think we're in there's plenty of reason to be optimistic, including the fact that the economy and the positive is broadening out beyond technology. You see small caps, and you see, I think the economy doing better on a broader basis. You've got extensive deregulation, which is a positive. You've got tax cuts coming, which is a positive. So I think there's plenty of reasons you got low energy prices. So we can tick through a whole set of things to be positive about. Some of the concerns that I still look at are the ones we talk about every time here. The fiscal situation, the federal debt, spending continues to be at 25% of GDP, which is way above trend line since World War II or the last 50 years.
Right.
And that's an issue. And you look at a place like Japan that recently had the spike in yields tied to the level of debt there. So that's still a concern. There's clearly a shift going on in the technological world and in AI as everybody's trying to figure out where the different providers are. When I look at AI, Andrew, there's the universe of people that are bringing the agents and that are investing in all of that, including the data centers. And then there are all the companies that are trying to use it to become more productive. And I think there needs to be more focus on the latter, because the success of this technological revolution will come down to the thousands of private and public companies that are trying to use the tools to increase productivity and create an overall higher level of growth in the American economy.
That makes a lot of sense. But the gains that we've seen in the markets, the valuations on some of these things, the capex that we're seeing on that, is it justified by what you're talking about, the real good that's there? Or do you anticipate that we will see some market swoons as a result of the market kind of getting out over its skis?
It's a great question. First of all, after the last 3 years, 54% increase over 3 years, when we've seen that in the past, the fourth year is always more volatile. It's later in the cycle. You have repositioning from one sector to another, which we're having now. So we expect more volatility this year, and we're seeing it. The other thing I'd say, Becky, on that is that there will be winners and losers in all that CapEx. And there will be, and you see this, the market's pretty harsh if anybody misses. Even a Microsoft misses, and it's off double-digit percentage-wise. So there will be winners and losers in that. And obviously, all of the CapEx going into the creation of the tools isn't going to get the return that everybody's looking for. But if there's enough of a productivity surge on the other side, it can justify the overall level, or come closer to justifying the overall level of investment, $500 billion last year, more going forward. It is a technological revolution. If the product of all of those investments does change the way every company, public and private, in every industry functions and makes them more productive, then the revolution occurs, and there can be some.
But do you think on the other end
correlation between the amount that went in and the other side? But it has to be a broad-based impact.
Do you think there's going to be enough people who have jobs and are making more money to pay for it? So, for example, I imagine your financial advisors who work with you are already using AI a little bit, maybe?
Yes.
Okay.
And my company is.
And your company is.
My company, like every company, is trying to figure out how to take the tools and make everything more efficient.
So right now, I imagine it's trying to make some of those people more productive, and maybe it is. The question is whether the MD that used to have a couple of analysts that worked with them is going to need all of those analysts in the future, and what that ultimately looks like. When you think even about hiring, for example, over the next 12 months, has it changed?
Well, I'd say two things on this. One, if we have a team of private advisors and they have, say, 20 clients and they're managing $100 million for each client, so it's a $2 billion book of client assets, and there's 5 people on that team. It could be they'll have 40 clients at $100 million each and have 6 people on the team in 3 years. And that's kind of the goal of the productivity increase. So, everybody's reaching for that, Andrew. The other thing I'd say is, and we've talked about this, there after the internet really took off, you had something called a search optimization engineer, which none of us could have conceived of, in 1995, and you had a whole bunch of them. Now I've heard phrases like a machine behavior auditor. Will there be a job for somebody to watch the agents and make sure they're doing what they're supposed to? Or another job I heard about was a forensic trust specialist, somebody who goes in and makes sure that it really is Becky on the video, and so maybe
Right.
PR firms are going to need somebody like that because the client says, hey, there's so much out there that's not us. So, technological revolutions create new jobs. And so far in history, and ultimately I think this will probably be true here, but there could be some painful transition moments. Every major technological breakthrough has created more jobs than it's cost in human history.
The other question I was going to ask you is about private credit, because we've watched some of the firms, even the last week, the Blue Owls of the world, KKRs of the world, they've all taken a hit. There's been big questions about private credit. I don't know if you tell your clients to get into private credit, out of private credit, what you think. You've lived through crises before. Some people think it's systemic. Some people think it is not a systemic problem at all. What do you think?
Well, I think, first of all, our clients are much more broadly diversified in alternatives. And alternatives writ large, private credit, all the different infrastructure, obviously original private equity, went from $1 trillion in assets in roughly 2000 to approximately $20 trillion today. So it's an incredibly large, important group of investments, particularly for high net worth and ultra high net worth clients that can deal with the illiquidity of alternative investments. So it's an important diversification for all of our clients. When I look at private credit, it stepped in a lot as the banks pulled back after the credit crisis, which we all watched. So you do have, obviously, credit risk embedded in there. And there have been a bunch of high-profile issues in the last 12 months. Whether there's anything broader on that is tied to the larger economy. And the economy clearly continues to do pretty well. So,
well, it's just public credit. I'm talking about, you've got such rich clients, you need fixed income as a major part of all your portfolio. Kevin Warsh, the Fed, $38 trillion. Is there a problem? Would you extend maturities? Are interest rates coming down? Where would you go on the yield curve?
Well, this is my biggest concern, Joe, the magnitude of the public debt. That is the single biggest issue that we still have as an economy. The good news in the recent period is that real growth, as you know, and you talk about a lot here, has been much better, 4.5% or so.
It's the only way out of this, man.
So if we can grow at 4 or 5% real, and you have 2 or 3% inflation, even with the 5 or 6% budget deficit, you're growing on a nominal basis more than the budget deficit. But it would be a lot better to get the spending house in order. And that'll be part of the challenge for Kevin as he steps into this job. He's going to focus, obviously, on the monetary side. I think, he's a guy with tremendous experience, obviously Fed governor, private sector.
Would you buy duration based on this new guy?
His perspective on the issues that are most important to the Fed brought some confidence to the market on duration. There's no question that happened when he stepped in. But it's a difficult balancing act because he's got the monetary side, and obviously he's only one vote, even though it'll be an important vote. And the fiscal side continues to be such a challenge. That's the risk on duration, not what I think Kevin's going to do as the new head of the Federal Reserve.
Right. Because there's a time, you didn't sound like you're that optimistic on stocks. So would you increase fixed income with people that need it?
I'm not optimistic. We've had 3 great years before this year. So, the fourth year.
Where else would you go?
Well, fixed income is an important part of our clients' portfolio, no questions, and including in a private credit context.
Private credit as well, yeah.
And I do think the Fed, with the new leadership, is going to be quite focused on the inflation side of the equation. The fiscal house, it would be a lot better. This conversation would be a lot better if the fiscal house was in order.
Does the Fleming family have a lot of munis, long munis?
All high net worth and ultra high net worth clients across the universe have significant exposure to municipal bonds.
Long munis. 10-year, medium term?
It's across the spectrum. Typically, it's a laddered portfolio. But
and you'd buy now.
Where are you asking me on the ladder? You're asking me farther out on the ladder? The fiscal situation is a risk for longer duration fixed income, and that is something that should be addressed.
Thank you, Greg. Nice
Great
to see you,
see
sir.
you all.
Thank you for coming in.
Okay.